family. Welcome to another edition of Melon Economic News. Welcome to this afternoon edition. Alright, we're going to go ahead and get it started, alright? Let's go get it started from from ZeroHedge.com. Financially devastated. 83% of New York restaurants unable to pay July rent. Okay, now before we go ahead and get it started, go ahead and hit that like button. Go ahead and subscribe so we can keep this going. I do this for free. Alright, this is out of my own money in pocket, but family, is more important that you realize what's going on, because the mainstream media, like we said before, don't give you the stories. Alright? But let's go ahead and say it. First of all, from ZeroHedge.com, financially devastated. 83% of New York restaurants unable to pay July rent. Alright, the state of New York restaurant industry is in a dire straits. July proved to be yet another disastrous month for restaurants, bars, and nightlife establishments across the city, with majority unable to pay rent in July, a new survey found. NYC's, or New York City Hospitality Alliance, surveyed about 500 owners and operators of eateries in the city, with 83% of respondents indicating they could not pay the entire rent in July, while 73% paid no rent at all. Alright? Restaurants and nightlife venues are essential to the economic and social fabric of our city, but they are struggling to survive, and absent immediate and sweeping relief, so many will be forced to close permanently, said Andrew Riggie, RIGIE, Executive Director of the Alliance. Alright, goes on down to say, to make matters worse, 71% of owners and operators said landlords would not waive portions of rent due to COVID-19. About 61% said landlords would not defer rent payments, while 90% of landlords would not formally renegotiate leases. Because what's happening is that they can't pay the landlords their money to who own the property who own the land that they put their business on. And what's happening is, since they can't pay the landlords can't pay the banks who they took the money from to purchase that property. All right. So it's when one can't pay one, the other one can't pay the other. That's what's going on out here. So they're really hurting up there, and they're really hurting down there in New York City right now. All right, and that's just not in New York, NYC. That is happening countrywide. But most towns that had a good nightlife scene are really feeling the devastating effects of what's going on. All right. So that's it. That's it for that story. We're gonna go ahead and keep it going with this one, and this is an update to what's going on that we reported earlier. Banks cut off credit. All right, this is coming from beforeitsnews.com. All right, beforeitsnews.com. All right, that's what it's coming from. Banks cut off credit, prepare for loan losses as demand collapses. Auto loan demand hits record low. All right. Alright, and here we go with this one. The bad news is the U.S. economy runs on credit. The worst news is banks have begun to cut us off. Alright, banks have tightened lending standards at near record pace. In fact, there is only a few times in U.S. history where banks have been less willing to lend. The other disturbing trend The other disturbing trend has been the near record loan loss preventions. It is clear the banks have been preparing for a rush of loans turning sour due to the near record pace of unemployment we've seen so far in the United States. All right. Honestly, everything in the nation runs on credit. We're a nation that runs on credit. People are always going to get credit, buy everything on credit, pay it back later. But now that balance, the check and the balance has come due. All right. Honestly, everything in the nation runs on credit, and the banks are beginning to limit credit, especially to those that are in the lower income brackets. There's also reports that people have been seeing their credit limits lowered, and even though they haven't even missed a payment yet. All right. It began with J.P. Morgan that they initially raised the bar by making sure that those who were applying for mortgages had a credit score of at least 700. All right. And they also wanted a down payment of 20% of the home's value. So if you went to J.P. Morgan first, we reported this earlier, we said again, that if you went to J.P. Morgan for a mortgage, they wanted your credit score of 700, and they wanted 20% down. It used to be 10% down, and the credit score was much lower. But now once again, they upped it. J.P. Morgan Chase, they've upped their credit standards to where you need a 700 credit score and a down payment on a home of 20% of the mortgage loans. All right. So if you were getting a home that's $200,000, you need $20,000 down. All right. The next step after that was cutting off all loans extension that essentially are not backed by the government, like the Paycheck Protection loans. So basically, if you're not getting a loan that's backed by the government, you ain't getting no. Don't even bother trying to go. All right, that's basically what this article is saying right here. Banks have now become tightened. If the government's not backing your loan up, don't bother coming knocking. All right, even if you got a credit score that's good enough to get what their standards. All right, the only reason banks would begin cutting off credit is they did anticipate people would not be able to pay their loans, if we have seen a huge rise in delinquencies and defaults. And others believe the value of the collateral that is used to back these loans is going to drop in value. Banks are currently preparing for an all-out economic collapse, because that's exactly what is happening. I'm going to read that again. The banks are currently preparing for an all-out economic collapse. That's because that is exactly what is happening. All right. The interesting dynamic in all of this would be the collapse in money demand, because recently there have been suggesting that we're on the edge of a big V-shaped recovery. However, we have seen that we have just had record low auto loan demands, and most recent data was from July. All right. I'll finish up with this one right here. Mortgage demand has dropped in just about every single segment, and banks have been tightening lending standards on just about the entire mortgage market. Now, it is possible at some point we have a recovery, but one thing is certain: we are not in a V-shaped recovery. If loan demand is falling and the banks are cutting off credit for the poor, they are boarding up windows and preparing as if a storm is rapidly approaching, because it is of course. All right. So that's it for that one. All right. Just remember, the banks are raising high standards. Just only J.P. Morgan Chase, that's one of them. But go to all banks and all credit unions. Everything is being raised. All the mortgage standards are being raised. Auto loan standards are being raised. They've been extended out months. All right. Not just 2 or 3, 4 years. They're talking about going to 6, 7, 8, 9 months mortgage loan for auto loans. All right. And this one right here, I wanted to show you this. I want to show you this for our final story. This is from U.S Debt Clock.org. All right, U.S Debt Clock.org. All right, hopefully I get it in so you can see it. But this is what I'm going to show you about the U.S. Debt Clock in real time. All right, we're not just going to show you that, but we're going to show you the states as well, the worldwide as well too, family. So here we go. All right, so if you can see that, I'm trying to get close as I can. This is the U.S. national debt, $26 trillion and counting. All right. $26 trillion. We'll slide over a little bit. If you can see, debt per citizen, $80,000. All right, you over $80,500 per citizen. Per taxpayer, this is with the national debt is climbing. We're now per taxpayer, and if 47% of taxpayers take care of the other 53%. We're looking at $213,000, almost $214,000 per taxpayer. So we owe. All right. Compare that to the federal revenue, just over $2 trillion. All right. Now we'll switch down. We'll go to say U.S. federal spending officially for $5 trillion. All right. See those 4 commas? That's trillion. All right. All right. Then we'll go ahead and slide down to something that's more disturbing. All right. If you can see that one, I'll try to make it better. So please forgive me, family. All right, the total U.S. debt. This section over here, unfunded debt and interest. All right, the total U.S. debt is at $80 trillion and rising, getting close to $81 trillion. All right, so look at that, $80 trillion about to break $81 trillion. All right, that's astounding. That's outstanding, family. I mean, outstanding in a bad way. All right, that's total U.S. debt. Okay. Alright, so we're going to switch right here, then we're going to go ahead and go to the World Debt Clock. This is worlddebtclock.org. You is still on the website, usdebtclock.org, and we go ahead and look at what's going on here, family. Look at this. The number 1 country in the world. You got United States, USA, China, Japan, Germany, UK, France, all and so forth, going all the way down. But look at the top part. USA. Alright? National debt. $26 trillion. All right, switch over. The GDP of the country is at $19 trillion. U.S. total debt, 26 trillion. What we gross domestic product, what we get every year, 19 trillion. All right, we're running in the negative, in the red. All right. Now you can sit there and you can blame President Trump all you want, but this started way below that. All right. And got public debt ratio to GDP ratio. We're running at 102%. What is about to hit 103% debt to GDP ratio. All right. So if you had 100% GDP, we're now operating over GDP. That means we're in the negative. We're in the red. All right. We don't make enough money to even service paying off the debt. All right. 102.78%. Just about round it up. Go and call it 3%. 103% to debt to GDP. All right. That's just unsustainable. All right. And if you look at some of the other countries, no other country in the world has that much debt. All right. So now you know what's going on, family. All right. The country's in bad shape. We're in big debt. All right. What the national debt is and what its real debt is a big difference. All right. All right. So, family, I want you to thank you again for joining this Melanie Economic News. All right, go ahead and hit that button, like, subscribe, and comment. Constructive criticism is always welcome here. All right, and so we can I can make sure that we can get this channel better and we can get you more, bigger, and better information. All right. Once again, thank you for joining us this Melanie Economic News. Like, subscribe, and comment. Take it easy, family. Please take care of each other out here. All right. Thank you once again. Let's get it started.